that I forgot the numbers. The tickets that you paid for are going 100% towards legal outreach. I was told we raised, as of last night, more than $13,000 for the program, and our company will match that. So today we're giving more than $26,000 in legal outreach. Thanks for doing it. We're going to have about 10 minutes, maybe 15, of a brief overview of what we've seen in 2015. I'm going to talk a little bit about what we believe we're going to see in 2016, and then I'm going to open it up to the panelists that all of us want to hear. We've had a very successful 2015 as a market, $70 billion worth of investment transactions in all boroughs of New York City. In terms of transaction volume and property value, those stayed somewhat flat compared to the dollar volume. If we're going into each one of the boroughs, and we're starting in Manhattan, below 96th Street, we've seen about $50 billion worth of real estate transactions. Out of the 776 transactions that took place, 7 were above $1 billion and accounted for $17 billion, or 34% of the dollar volume. That means we're in a period of time, or we were in a period of time of massive transactions, significant transactions that took place. Clearly, Steintown, 11 Madison, 3 Bryant Park, our XI office portfolio, and others that contributed to that. That's a staggering statistics and something we should remember. When we talk about Manhattan below 96, often we talk about the luxury apartment market. What we're told is that this market has declined a bit over the past 12 months. We're talking about an 8% decrease in average pricing per foot for the luxury market alone, and a 14% decline in terms of dollar volume. Our research department looked at the prices per foot on average, per buildables per foot on average in Manhattan below 96 for 2015, and realized it was about $610 per buildable square foot. We asked them to look at what's on the market and try to understand what people are asking, and the average ask for Manhattan below 96th Street is $800 a buildable foot, which tells us that there's a big gap between the expectations of sellers and buyers in terms of pricing, which might and will probably slow down the transactions of land in the coming year. The multifamily market in Manhattan below 96 has done extremely well in terms of dollar volume, $13.3 billion of real estate or multifamily transactions specifically in Manhattan below 96. Very important to qualify that by one transaction, which is a $5.45 billion. That's the Steintown transaction that took place in 2015. Pricing has gone up by dollar volume only, 8%. Capitalization rate and gross rate multiples stayed more or less the same, which tells us that Manhattan below 96 has stabilized somewhat in terms of pricing of multifamily assets. That's not the case, by the way, when we discuss other boroughs. International investment has been robust, $23.5 billion of foreign investment, not just acquisitions, but development and others. And we're talking about Chinese, Canadian money, Singapore, Norway, and others. Definitely helps Manhattan below 96. The next sub-market that we viewed was Brooklyn. Brooklyn had an excellent year in terms of volume of transactions, $9.7 billion, 50% higher than the year before. Very similar to Manhattan below 96th Street. 13 transactions, or about 1% of the transactions, accounted for 22% of the dollar volume. All of these 13 transactions were $100 million or higher in Brooklyn. It's important to remember that in 2014, we had maybe one transaction close to $100 million. And again, very similar to Manhattan, very large transactions took place in that area. In Brooklyn, when we spoke about Brooklyn in the past, we discussed mostly the residential market, which we will here too. But it's important to mention there's about 16 million square feet of office space under construction in Brooklyn today. It's not just downtown Brooklyn, it's also Bushwick, East Williamsburg, and Sunset Park. The residential market in Brooklyn is doing also extremely well. There's a lot of units that are being built, 18,000 to be exact. We expect to absorb them hopefully in the next 5 years. 5,000 units are coming on the market this year. It's also important to mention that we see 25,000 newcomers to Brooklyn over the past few years, year after year. And yes, there's a question of absorption, but there's a big demand to living there, and now as we can see, working there. Important to mention that 8% of the buildings that are being built for residential are residential rentals as opposed to residential condominiums, which in our opinion provides an opportunity for developers to develop homes and apartments to the residents of Brooklyn. A testament to the strength of the Brooklyn market are areas like Boerum Hill and Carroll Gardens, where prices per foot are $1,200 and $1,300. These are not Dumbo or Brooklyn Heights, but those are great neighborhoods. It just shows the strength of that borough. Queens showed about 20% increase year over year in dollar volume. When we discussed Queens in the past, we spoke mostly about Long Island City and Astoria. Today, it's also Jamaica, and it's also Flushing. And Long Island City and Astoria kept their pace in terms of development and the fact that, owners want to be there. It's closer to Manhattan. There's a lot of effect in the Roosevelt Island development of Cornell Tech. Developers today are looking at Jamaica. Proximity to the airport and foot traffic is something that is of interest to them. 2015 has been extremely good for Flushing multifamily, mostly because of the prices that are relatively lower there, or were lower there compared to other areas in the city, and the anticipation of growth in terms of tenancy rental. Northern Manhattan, actually a decline of 20% to $2.5 billion in investment sales transactions in 2015. I'd like to qualify that by saying that in 2014, there was $1 billion transaction that took place, and that skewed the numbers. If you take that transaction out, we're talking about a 16% increase. Upper Manhattan has done extremely well, mostly on the commercial avenue of 125th Street. But now 125th Street is not only Whole Foods or the Columbia expansion. It's Savannah that's buying on Park Avenue. It's the Children's Place building that was traded a few times over the past few years. And it's Red Rooster, which is in contract to sell for about $850 a foot based on Bloomberg. So it's not only 125th Street. If you want to look at further, you look at East Harlem that improved on a price per buildable square foot basis on land by 90% in 2015. Prices of land there appreciated dramatically to close to $200 a buildable. And if you want to look at other areas in Upper Manhattan, you can look at Washington Heights, mostly in the multifamily sector, where prices have gone up by 30% if you look at the price per foot matrix. Last but not least is the Bronx. In terms of dollar volume, 16% increase. The Bronx, when we talk about the Bronx, people ask us mostly about the South Bronx. We'll get there in one slide. But this year, 2015, we've seen 550,000 square foot of retail change hands, $256 million in areas like Westchester, Bronxdale, and companies like Excel buying them. In terms of the South Bronx, or Mott Haven specifically, prices per land there went up to about $90 a buildable foot, with some of the major players that purchased land in the past few years are expected to start construction soon. The multifamily market in the Bronx has done well in terms of pricing, and we believe that in terms of all boroughs appreciated the most by about 30% if you look at the price per foot, and about 20% if you look at the gross rent multiples. It just showed us that investors crave yield, and the Bronx could provide that in the multifamily asset class. In terms of where we see the market in 2016, we thought we'd speak a little bit about headwinds and opportunities. Well, it's not a secret that the world is in turmoil, that, we see what's happening in China, we see that Japan is lowering their interest rate. It's important for us to take note of that. In terms of the current market and the New York market and New York administration, we think that we should watch for the rent increases of the new administration, so far 0 for 2015. 421A is definitely an issue, and the sustainability of the luxury market is important for us to watch as well. In terms of the strength of the market and the outlook of that, we have an extremely good economy in New York City, net positive job creation. In terms of inventory, I always hear from buyers and there's not enough inventory on the market, there's not enough to buy. In terms of new industries that are in the city, technology, advertising, media information, definitely helps tenancy, mostly on the residential side. And the new expansion of universities is something that we should also take note of. Last but not least, we believe that international investment will continue to be robust here in the city. In conclusion, really hard for us to say what's going to happen for the full year because of things that are in contract and residuals from last year. We believe that the first half of 16 will be very similar to the first half of 15. If I had to guess, at the end of the year, we'll see a little less volume in terms of transaction. Pricing will probably stay the same, or go up a little bit, especially in the multifamily asset class and income producing. Land will probably trade a lot less. With these predictions, I'd like to end my presentation and go to the panelists and start a discussion with them. Thank you. So as I mentioned before, we have 3 esteemed guests here, and what I'd like to do is have them give us a couple minutes of who they are, what their company is doing, and then move on to asking a few questions and learning from them. We'll open it up to questions and answers later on in the discussion as well. First, Ofer Yardeni of Stonehenge Partners. If you can give us a few words about you on the platform, I'd really appreciate it.
Hi, good morning to everybody, and thank you very much for coming. I'm quite stunned to see such a large audience at such an early time in the morning. I don't know if it's because the market is so hot or because none of us has anything to do during the day. I really don't know about it here, but thank you for being here. I've been in the real estate business for, I can't believe, almost for 28 years. For the first 5 years, I started like Shimon as a real estate broker. And when the early 90s, I decided that it's too tough to be a broker, and I wanted to shift to the other side. And I started to acquiring loans from the RTC and from other institutions. Early on in my life, I had a vision that I want to create a company that will be vertically integrated. Some people say that I like to control things, but I really realized that my vision and my partner during that time, George Sion, was very, very helpful for me. We decided to create a company that will do everything in-house and to develop expertise in asset management, in property management, in leasing, marketing, financial, and to try to do everything in-house. Over the last 25 years, I was lucky enough to buy close to 55, 60 buildings, accumulate a portfolio of, well, the highest, it was around 6,000 square feet, 6,000 units. And today we have 23 buildings in New York City, in Manhattan. Our core growth is still in Manhattan. We are value add. And we have over 3,000 units, over 3 million square feet. We are almost in every segment here in the city. We have over 210 employees in the company. In the main office we have 55, and we're looking to hire even more. And I am looking to grow this business, and I just bought another partner to our company, Shkury Capital. Well, it's an investment firm. So we are going to continue to do what we did in the last 25 years and buy multifamily and retail here in the city.
Thank you, Ofer. Martin Nussbaum of Slate.
My name is Martin Nussbaum. I'm one of the co-founders of Slate Proper Group. I want to thank everyone for coming out this morning as well. And Shimon, thank you for having me as well. Very simply said, I think what I would like to do is try and become like Ofer. Right? He's been in the business a long time. He has done a phenomenal job doing what he's doing. And I said to him when he came up, it's the first time I'm meeting him, and I appreciate meeting him. I look forward to spending some time together in the future. So my business is a privately owned real estate firm. We are, like Ofer, fully integrated. We focus on multifamily, mixed use, and condo projects both in Manhattan and Brooklyn. And I think when we first started the business, we really wanted to have the flexibility to grow through different markets. And our thought process at the time was, let's identify different areas that we feel we can go up and down through different cycles. So we split the business into two sides. We split the business into buying of existing multifamily buildings, which we do predominantly in Manhattan. We do a little bit of in Brooklyn, but predominantly in Manhattan. And over the last 5 to 6 years, we purchased probably about 50 buildings over that period of time. And again, very similar to Ofer, very much value add, reposition type of assets. And then the other side of the business has been ground up development in Brooklyn. And currently we're building a portfolio of about 2,000 apartments. And we have about another 500 apartments that are units that are under construction that are going to be condo. So we really tried to build a platform that we can grow off of that allows us to sort of continue to build a real estate portfolio that we can own and manage long term, but at the same time try to capitalize on different cycles of the market where we think we can take advantage of the condo market at one specific moment, the rental market, and obviously inherently what we do is we own a fair amount of retail because a lot of our buildings have retail on the base of the building. We've really also tried to identify different equity sources and capital sources to help us grow our business like everyone else. So we started off our business, on the smaller side with a lot of friends and family and high net worth investors, and that has grown over the last 5 to 7 years into predominantly institutionally based investors, and both U.S. based and overseas based institutions and investors. So that I think again has allowed us to set up a platform that we can grow through different times. And if a certain market's not doing really well, for example, everyone's a little bit worried about China right now. We have investors in China that invest with us. We have investors in other parts of the world, so that we can continue to sort of do business during different times of the market. We have about 50 people in our office at the headquarters, and outside the office we have called another 75 to 80 people who work in different sections of the company. And us two are looking to continue to grow the business and institutionalize it to the point where we own a portfolio on a long-term basis that we can operate long-term.
Thank you. Blodgett, Fairstead Capital.
These guys are pretty smooth. So we are a New York City multifamily, real estate investor backed by a very large family office. In the past 18 months, we've bought $1.5 billion in New York City real estate. Our portfolio is probably valued at 2.5, comprised of about 5,300 units. We're in both Manhattan, Queens, and Brooklyn, and we go all the way from high-end luxury to low-income affordable. And we have about 700,000 square feet of retail as well.
Thank you. So the first question I have is, we're trying to predict 2016. Everybody's talking about uncertainty and what's happening in the market. And, you know, you have companies to run, you have investments to make. When you looked at 2016 strategically, what were your thoughts and how do you change what you thought about in 2015 for 16, if at all, and what's your plans for that year?
So those of you who don't know me, I can tell you that I'm one of the most boring guys that you'll meet because I don't change a lot and I'm a creature of habit. And being a creature of habit, I started my business in the early 90s, and when I started my acquisitions, I came to an idea, how should I buy real estate in this market, and how can I compete with the other families that were here for a generation before me. And it was very easy for me. The first building that I bought was, that I closed on, was on West 89, Stonehenge Tower. And when I bought the building, I paid $8.8 million for 150,000 square feet. Clearly the market said that I overpaid by $200,000, of which was a lot of money then. But if you look at the metrics that I got, the metrics were very simple. I paid around $80 per square foot for the building. And the condo market was selling for $200 a square foot. And replacement were around $150 a square foot. The average rent in the building was $700 and the market was $1,600. So after 20 years or 21 years that we own the building, I'm sitting with my kids and they said to me, "Daddy, you are very, very smart because you bought this building after 21 years. And the building, we got an appraisal and the appraisal said that the building is worth $100 million. For my kids, I was very smart because here after 20 years, I made a lot of money. But to be candid with you, that's what happened when you own multifamily. The market really drives and do a lot of work for you. It's not that we are so creative and we should take all the credit because the market really took off. And if you look at the fundamentals of that real estate, of which I still own today, when at $100 million on this property, the price per square foot is around $800 a square foot. There are some developer here, like Mr. Schuster, he will tell you that on the Upper West Side you can sell condominiums at $2,000 a square foot. Replacement or even more, he tells me, but I'm conservative. So replacement will be around $1,500, $1,600. My average rent in the building is $1,600 and the market is $3,500. So after 21 years of owning the building, the same fundamentals are for me as if I was in 1995 when I bought this building. So really, if somebody can say to me, "Are you going to sell this building?" I say, "Why would I sell the building? I still can grow the building and I still can develop this building." So I am not a buyer on cycles. I'm a fundamentalist. I look at value. And the same thing when I bought the building with my team, we bought 210, another 210, West 70. We just closed the deal in December. So here, this is a building with 170,000 square feet. The building has 170 units. We paid there 132 million, 133 million. And if you look, we are paying around less than $800 a square foot. On West 70, where the condo is over 2,000 square feet. My average rent in the building for the rent stabilized is $26. The fair market are $60. So if you look, the market is around 75. So all I have to do, I have to really renovate the building from lobby, hallways, apartments, combine some of the units, buy some of the tenants. But the same fundamentals are for me, for this purchase in 2015, as if I did in 1995. Now maybe in 1995 I didn't know the market so well and I succeeded by default, but over the last 20 years, if you look at every transaction, and it's good for you for the brokers, that if you see a deal that the price per square foot is 50% of condo replacement on 60% below condo, and if the average rent is 50% below market, forget about the cap rate. Cap rate doesn't mean anything. Those people who buy cap rate and based on Shimon's number, and most of the brokers, you feel you're buying 3-4% return, honestly, they don't know how to count. Because the expenses that they put are not the real expenses, and basically the income that they show is the real income. But if the fundamentals are there, and if you are buying it based on price per square foot, the best is yet to come, and it doesn't matter about cycle. You have to continue. You just have to have a quantum leap that 20 years ago you paid $70, and today you pay $700 or $1,000. But the fundamentals you have to look. So we are fundamentals, and that's how we buy real estate.
2016.
Yeah. I agree with a lot. I agree with a lot of what you said, and a lot of it I'm not sure I agree with. But I can tell you our thought process on how we're looking at 2016. 2016 is probably not going to be a year where we're buying a tremendous amount of development sites. Like I said before, our business is very development and existing building based. So I think that we are taking a look right now and saying we want to own hard assets. We want to own real estate that has cash flow, albeit a 2% return or 3% return day one. I agree with Ofer, the cap rate going in is sort of irrelevant to us. So I think for 2016, we looked at a couple of things. We would like to purchase more existing building properties because we think that we have the capacity to turn those buildings around in a faster period of time than buying a piece of land. It can take us 2, 3, 4 years to get a building built and go through the process. So I think we're definitely focused on that. And in light of that, we just closed on a building on 54th Street. It's a 315-unit building. And I agree with Ofer 100% that you have to look at basis. And that's exactly why we bought that building. We purchased it for $390 million, which is a price of about $850, $875 per foot. So replacement cost and the rents in the building don't sort of, I agree with Ofer on the condo analysis that he gave you.
I'm still waiting to hear where you don't agree.
Where I don't agree is that we really are focused also very much on rent stabilized. And I think that the change in policy that's happening now is concerning for us just because we don't really know where it's all going to land. And I think there's a lot of rules and changes that are happening that are gray and unclear. And when we look at basis, you have to take a discount to the rent stabilized apartments because you can't mark to market those apartments in a formulaic, guaranteed way. Now, if you're holding the asset for 15, 20, 30 years, it's a very different business model than our model. But, the way that we underwrite deals is usually on a 5 to 7 year hold. And we've shied away significantly from looking at any buildings that have a rent stabilized component that requires us to sort of turn apartments because I think that part of the market is a little bit concerning for us.
So if it was the Republican debate, which was high level.
Who would you be?
If I can respond, the fact that Marty suggests that he is not going to acquire the residential, the rent stabilized, for me it is a great thing. Because I support, and it will be very surprising to you, in my business plan, I would like rent stabilized to get increases of 1% or 2% or 3%, but this is not where I make the money. I have no issues if rent stabilized for the next 5 years will have 0 increase in the rents. Because for me, if I make on the $800, 1% or 2% doesn't mean anything. I need to get the vacancy. When I get the vacancy, I take my rent from 800 to 4,000 or 5,000 or 3,000. So I don't make the money on the rent stabilized. Now, how do I get the vacancy? I can offer incentive to the tenants to move from a 2-bedroom to a studio, to renovate, and always money helps. So I like the rent stabilized. I love regulation. The more regulation, I go to sleep, I say, De Blasio, give me regulation. Because when the market has the regulation, it creates inefficiencies. If the market was all fair market, why would I invest in New York? New Yorkers are smart people. They have requests, they have demands. I'll go to buy in Georgia, in Atlanta, garden apartments. Or Colorado, they're all, with chocolates or gummy bears. It's a wonderful world. New York is a tough market. We need to get paid for it. So regulation is fantastic for my business. Guys like Martin, it's fantastic that he doesn't like the rent stabilized. He's professional. I'm taking another one out of the business, not by doing anything. So these advantages are working for me. And I know that in this business, only the best will survive, not the good. And I came to my guys this year, the motto, the business plan is, good is not enough. Great, we need to be great. I like perfect, but nobody's perfect, but great. So in this business, in this regulation, you need to be great because you have, I come from Israel, so I always have the idea of the missile and the scuds, and everybody's shooting at you at the same time. So, but at the end of the day, it's a great industry.
I 100% agree with Ofer. I think that people right now are very afraid of rent stabilized, and there's going to be real opportunity there to purchase some rent stabilized at prices that are somewhat irrational. On the flip side of that, about a year ago we sat down and we said people are going to be afraid of rent stabilized, which means that they're probably going to overpay for fair market stuff. So we said, let's figure out a way to get a portfolio that's almost 100% fair market. So we kind of scoured the earth and we found the Payola portfolio, which is, 97% fair market. And then we said, we like that type of a situation. So I think right now, so here in New York City, I feel like you can always make money and do well in multifamily, right? It's about purchasing at the right basis and buying the right type of building for the right type of situation, right? So we bought Payola at under $900 a square foot, which I thought was the right basis, and it was 97% fair market. So I think for the next 1, 2, 3 years, people are going to be afraid of rent stabilized and therefore overpay for fair market stuff. And now I have 980 units of fair market housing that if anybody here is interested in overpaying for, please come and speak to me after.
We have multiple sources of capital, and I think we've really made an effort to try and identify capital sources that are looking for different needs, because there are different types of deals and there are different requirements that every equity source has. So we're obviously dealing with all the private equity real estate firms here. I think the private equity firms are typically underwriting over a 5-year period of time and looking for mid to high teen net returns, which I think are generally speaking hard to achieve in the buying of existing multifamily space in Manhattan and Brooklyn and Queens. I think you have to be fairly aggressive with your underwriting, particularly on rent stabilized buildings, to achieve those kind of rents in that short period of time. So I think that's one source of capital that we've sort of pursued. We have foreign capital, large institutional capital and overseas capital that I think have a little bit of a different requirement. I think they are looking at their local economies and seeing what's happening, and I think it's an opportunity to put money in a safer location. So there are often times where we have conversations with foreign capital where the conversation is more about preservation, a little bit lower yielding, less sort of risk-reward requirements, and I think that capital is a lot more interesting today because those are the kind of transactions you're seeing a lot more of in Manhattan. And then lastly, we've identified 2 capital sources that are very interested in condos, which I think again is pretty unique right now. And I obviously we haven't discussed the condo market yet, but everyone's going to share their opinion. We feel that specifically in Brooklyn and certain submarkets of Manhattan, building not relatively reasonably priced condo product is something that can still move and is still very, very interesting. And we have several projects that are on the market right now where we're seeing turnover and we're seeing product moving at a reasonable pace. And then lastly, it's identifying the family offices. We have 2 family offices. We deal with one local and one also overseas. And their capital requirements are very different and a lot more long-term. And long-term capital, I think, in this market is probably the most interesting for us. And what we're pursuing most aggressively, because I think that's something that allows you to sort of live through whatever we're about to go into. If it's flat, if it's a little down, if it's a little up. I mean, I don't think anyone really knows yet what that's going to look like. But I do think you want the ability to have longevity in transactions today to sustain the asset and live to another day where the market moves like it has over the last 3 to 5 years.
So my business model worked a little bit differently. I studied university history and philosophy, and entering into this real estate business, I realized very early on that you need capital. And unfortunately, or not unfortunately, I didn't have the right capital for my family. So I was lucky enough to find an institution, Caisse de Depot, Ivanhoe Cambridge from Canada, 21 years ago. And I hear from a lot of my friends that after they do a deal or two, they always are chasing for another source of capital, and another source of capital, and another source of capital. And almost every deal they have a different source of capital. And I said to myself, it's so difficult to find deals here in New York. It's so difficult to execute in a transaction. How can I even imagine, while I'm looking at a deal, to look for another source of capital? So I said to myself, again, I talk a lot to myself, I said, how can I convince Ivanhoe Cambridge or Caisse de Depot to be my partner, not for one deal, not for 2 deals, to be my partner for a decade or 2 decades? So I'm happy to tell you that I only have 4 or 3 sources of capital. That's it. Yes. So my first partner that came with me to the deal in 1995 is still investing with me on my acquisition in 2015, the one that I just purchased. So we did over 50 deals together. So can you imagine the same partnership, the same lawyers, the same relationship? The only thing is that the analyst that used to work with me when he started, now he's maybe the chairman. So business is easier. They know me. They know all my flaws. I know that they have the money. I know what I have to do. So in terms of capital, I said I'm going to be the market share of my investor. I'll make sure to be so good and to do the right business by them so I can execute, if I get a deal, that it's a 50 million, 1 million, or 500 million, that I can execute with this partner going with me, so I never have to worry about capital. So I don't waste time on lunches or dinner or office building, hedge fund, how do you call the other companies? Private equities. They're all great. But if I can find one source, one phone call, it's a lot easier. And then I was very, very lucky to get introduced to SL Green. It's the largest commercial office building in New York City. And SL Green had a currency that nobody has, OP units. And giving shares to owners that need that currency in order to avoid taxation. So lucky enough, I was able to put a deal together with SL Green, and our first transaction was $450 million with currency that we give to a family where they avoided all taxes. And then we bought another 300 million, another 200. So together, SL Green and myself own $1 billion worth of real estate, and we are just beginning. Trust me, we're just beginning. Because more people would like to not to pay taxes, and more people would like currency. So if you think about it, with 2 sources of capital, I do business. I'm married with 1 wife for the last 20 years, 2 sources of capital or 3. I told you, my life is very simple.
Once again here, I agree with Ofer, which I think is a good thing in this crowd. We're attacked by a very large family office, Then we also have two other very large, family offices who also invest with us. And then we also have relationships with all the other equity shops out there, right? So what we're able to do is we're able to come in, see a deal, understand that it's worth, what is being asked, take it down with our internal family office. If we want to, we can purchase the whole thing, or we can go out and see what other people are willing to give us in terms of terms, etc. So I think it's really important to have, that capital in-house, especially in the atmosphere that we're about to go into.
Thank you. I have a Brooklyn question for Martin. In the presentation, we saw that there's about 18,000 units coming on the market. That's our statistics. Over the next 5 years, 5,000 are going to come on the market in 2016. 8% only are condos. 25,000 new residents based on what we know coming to that borough. What's your feeling about the amount that's being built in terms of rentals versus condos? What's your feeling about, is it going to be absorbed in the next few years, in your opinion? I know you're very active there, so.
So I think we saw the exact same trend a little while ago, and that's when we switched over to actually starting to acquire sites for condominiums specifically. I think there's a big disconnect between the rental market and the condo market right now in terms of supply in Brooklyn, and that was a thoughtful, I think, decision that we made to start building condos in Brooklyn because there is very little condo product. So I think specific to condos and the question, I think that there's not a lot of condo coming to the market in Brooklyn. There's a tremendous amount of demand, and we're seeing it on the projects that we're working on. So I feel like the condo market could maintain itself and be very healthy and sustainable. On the rental side, there's clearly a lot of product coming to the market. I'm not going to sit up here and tell you how wonderful I think Brooklyn is, because I think that conversation's been had at 13 other breakfasts that you probably have had already. Brooklyn's established. Brooklyn's a real neighborhood. It's not the little brother of Manhattan anymore. It's a standalone culture. It's a standalone brand. It's a standalone tourist destination. You walk into Brooklyn now, and I used to walk there 5 years ago, and it was me that looked like a tourist because I was dressed like this. Now you walk there, and there's people opening up maps and looking around trying to find out where the White Hotel is or Brooklyn Bowl. So clearly Brooklyn has become its own being, and I think that the demand for moving there, and people are legitimately moving from Manhattan to Brooklyn by choice. Manhattan is Manhattan. It'll never change. I think everybody knows that. But I look at a lot of the applications that come across our office for people moving into apartments in our buildings, and it's surprising where they're moving from. They could be moving from the Upper West Side, a family moving from the Upper West Side deciding to move to Williamsburg. It could be a bunch of young kids from the Lower East Side choosing to live in Bushwick. I mean, it's really, and well paid. They're not moving there solely for money. Clearly, cost and space is one of the reasons that people move to Brooklyn. But I think globally you're seeing that it's people choosing to live in Brooklyn as opposed to moving there specifically for money. The last thing I'll say is I think the fact that land prices have moved so much in Brooklyn has prevented us, and I'm assuming most other people, from being able to buy land to build it as rental anymore, at least over the last 12 months. So there's clearly a lot of supply coming to the market, but I would say about 6 to 12 months ago that stopped completely. Because you can no longer underwrite a rental based off of where land prices were coming in. And I also think that the 421A program is going to bring rentals temporarily, I hope, but for now, to a stop as well, because you can't underwrite building a rental unless there's some sort of real estate tax abatement program. So there's a lot coming to the line that I think we all know about, but I would say about 6 to 12 months ago, I feel like the rental market in terms of development and new opportunities came to a stop. So when you look 3 years out and 4 years out as to what the supply is coming to the market, I really believe that you're going to see very different numbers.
I'm going to say one thing there. So what he's saying basically is that housing comes first, right? People didn't build office over in Brooklyn. It wasn't happening. But then all of a sudden all the hipsters wanted to live there, and the artists, and then people like us wanted to live there, and people began to build office and cultural centers, et cetera, right? We moved from a manufacturing economy to a knowledge-based economy right? So people who used to live in the meatpacking district actually pack meat. Now it's us who live in the meatpacking district, right? And so when people wanted to go live over in Brooklyn, right, all the offices and the jobs, etc., follow. I think that's really important to keep in mind.
Let's stay on Brooklyn for a second. I have a question for Ofer. You really focus all the time on Manhattan, mostly below 96, a little bit above, but not a lot, 109, 113. What do you think about Brooklyn? Did you ever consider going there? Is that something that is in your strategy or thought process?
I've been in Brooklyn several times. I honestly enjoy wherever I go to Williamsburg, and I'm planning to go to Bushwick also in the next few weeks. Maybe I missed it. Maybe I missed the market. I didn't develop yet from ground, and I think that what Martin did, he developed in Brooklyn. I'm more a guy that buy either vacant building or existing building and renovate and bring back the glory for those buildings. I used to say that my company, we don't cross bridges or rivers, or we don't go through tunnels. We stay in Manhattan and we run our portfolio. You can walk to any one of our buildings. I can see all my buildings in one day, just walking and going through Greenwich Village and have coffee and lunch in Soho and come back for dinner in the Upper East Side or West Side. So I have quite a wonderful life. So we also manage the real estate that we own, and it's easy for us to manage it. And in fact, I said one time that if I can buy in one street on 48th Street, from river to river, I can own maybe $20, $30 billion worth of real estate. And can you imagine just walking one street and seeing it? It's great, and I chose 48th Street also because we have some buildings and you have Rockefeller Center and everything. So I have high thoughts, but the reason why I didn't go to Brooklyn on the residential side is, remember, when I buy a multifamily here in the city, I need to create returns. And I thought that if I concentrate on the turnover that I will have in the city, I can get a turnover from $1,000, and I can push it to $3,000, $4,000, even $10,000 before they change the law. If I get a turnover in Brooklyn or Queens, the average rent in the building is $700, I take it to $1,400. So the same work, and maybe in Manhattan it's easier to create a turnover than in the Bronx or Brooklyn, because where is the tenant there going to go? Versus in Manhattan, where I'm in the good location, and people have one bedroom or studio or two, it's easier for me to get a turnover, easier for me to push the rent, and everybody knows that the highest and best use in the city is condo, not just a rental. So I take the rent from $1,000 to $4,000, and the unit is worth suddenly from $300,000, suddenly it's worth to almost $1.5 million, $2 million as a condo. So for the same amount of effort, I get a higher return. And because we also operate our buildings, we realized very early on that the cost to run a building in Manhattan is a lot cheaper than to run it in the boroughs. And I'm sure some of you are very, very surprised about that. But if you think about it, real estate taxes is real estate taxes, it's percentage. Insurance depends on how big is your umbrella. Payroll is payroll, 32 BJ here, 32 BJ there, 32 BJ everywhere. It's the same rent. But if we talk about water, for example, I don't pay a lot of water even though I have a lot of tenants. We have over 5,000 tenants. But if you think about our tenant, most of them are young guys or girls in the mid-20s to 30s. They wake up in the morning, they don't want to take a shower in our buildings, they go to the Equinox, they exercise, they shower there and they go to work. They work so hard all day, they come home at 8, 9, 10 o'clock, they never cook, never use the kitchens, they go to sleep. So take the same thing unit in Brooklyn. They wake up in the morning, they make breakfast, they eat, they use the shower, they use laundry that they install illegally, and the cost of shower, the cost of water, then the landlord absorbs. They come back at 5 o'clock in the afternoon home. What do? They invite their friends, they watch TV. So the repair and maintenance are a lot higher.
I think it's really good that Ofer thinks that this is the demographic of someone in Brooklyn. That rents are $1,400 a month and that nobody goes out. This is perfect.
No, I'm not saying, I'm not talking about the luxury construction. I'm talking about, so the repair and maintenance are higher, and the collection is a lot tougher in a down market. It's a lot tougher. So we stayed in Manhattan by design, and I think that in the next few years we will find the right opportunity and we will go to those markets. But we need to find the right opportunity.
Here, I actually do not agree with Ofer. I think that he's not very well hedged, right? I mean, he's all in, he said he can get all of his assets, on foot, etc. I think that for us at least, we're all in the, in the NYC, what's it called? Multifamily world. But for our company, we're in Manhattan, we're in Queens, we're in Brooklyn. And we're also from all the way to the top, high end, to all the way to the bottom, affordable. Top or bottom, but spectrum. And I think that's also extremely important because we really don't know what the future is going to bring, right? I don't think anybody does in here. If we did, we wouldn't be here. But I do think that in our industry, it's important to be somewhat diversified.
So I'll tell you where I'm hedged. We have 3,500 units, and by the way, I'm not always right. I made plenty of mistakes in my life, so it might be one of them, but I don't think so. We have 3,500 units, 2,000 are fair market. So in that terms, that if the market continues to grow in Manhattan, we are getting all the benefits. We have around 1,000 units or 1,500 that are unstabilized. So we have the upside still in those units where we can get a turnover and we are able to increase the value upon a turnover. So if the market goes, let's assume somebody said, are we going to a recession? So if we are going to a recession and the market goes down, so my fair market buildings will have a reduction a little bit in rent, 5%, 10%, 15%. But my rent stabilized if I'm not going to pay the rent because they can't afford it. That's the best time for us guys, because then we're going to be able to buy those units and pay them and get those apartments and increase the value of those units. So I think I'm quite hedged, and I think that the fact that I am not concentrated just in one location in Manhattan, if we have 1,000 units on the Upper West Side, 1,000 units on the Upper East Side, maybe 800 units in Mary Hill, Greenwich Village, and we have next to Columbia University, so, and NYU. So I think that if Manhattan, and let's speak about it, which I have a tremendous respect for you and I always enjoy being with you, if the market goes in Manhattan, it's not that the boroughs are going to have a renaissance, it's going to have a trickle effect on them too. So, and if the market improves, the market will improve in Manhattan a lot faster than in the borough. So, who knows? God gave me the ability to buy where I bought. Until now, I think we did quite well, and hopefully we'll continue to do well in the next 25 years.
I want to wish everybody a great 2016. I want to thank Ofer